Welcome back to another episode of The Educated Homebuyer. This is where we answer your mortgage and real estate questions live while giving you updates on inflation, interest rates, everything that's going on with the economy. Once again, Mr. Josh Lewis is here, our esteemed mortgage professional, to answer all your mortgage questions and help guide us through this turbulent market that we're in at the moment. Josh, welcome back to the show.
I'm glad to be here for at least 20 minutes or so.
Yeah, so just a little update. Josh is going to bail on us a little bit earlier. He's got a flight he's got to catch. So we are going to do things a little bit differently tonight. We are going to keep the data a little bit less intensive, if you will. We're going to shorten it a little bit, kind of go over the things that we think you need to know, the things that are important. And then next Wednesday, we'll kind of bring it all back around. As the Fed meets, we'll have more information. But really, this week, Josh, not really a lot of data, not really a lot of changes in the overall market. Interest rates have come down a little bit. Inventory has built a little bit, and that's going to take us and do some charts right here. So those of you watching, I'm going to post a link to these charts here in just a minute, or listening rather. You can grab them in the show notes if you want to see them, but let's take a look at inventory to start, as we always do. So inventory increased, I believe, about 5,000 units over the course of the week, now sitting at 470,458. Orange County, we're up a little bit, sitting at 2346. Huntington Beach, we're actually down a little bit in inventory. But the market remains resilient and continues to kind of press forward. Inventory, again, same look at the chart we just had, just a little bit closer view. This, historically going back, we always look at these charts. I'm not going to dial through them just to get us, moving quicker. New listings are down. This chart right here I thought was interesting, Josh, just because it shows listings going all the way back to 2017 and where we stand comparatively speaking, and why inventory really remains, a problem. We're just not getting new listings coming to the market. So week over week.
That one, Jeb, if you roll back to it real quick, an interesting contrast. The very first chart that we talk about, total available inventory, you see that every year it starts increasing, but that is not due to additional listings coming on the market. You see those tail off through the rest of the year, but traditionally less demand through this portion of the year. So what listings do come on linger a little bit longer and back up in the available inventory.
Exactly. So homes that are coming on the market just sitting a little bit longer. Housing affordability, seasonality, right? People are out doing vacation stuff versus shopping for homes in some cases. So things tend to sit a little bit on top of sellers overpricing homes. That is still happening, believe it or not. Weekly inventory change, as we said, went from 464 to 470, just under 6,000 homes there. I think just around 5,000 homes added to the market. Last year, same time, we went from 487 to 508, right? So that was a difference of 21,000 homes back then, or last year rather. 2015, always like to mention that one, 1,197,000 homes. So significantly less during that period of time. Not going to go through these, just shows you that contracts are less, homes going pending are less, price reductions up a little bit. Again, we talked about this last week. You can kind of see this time of year, you start to see a little bit more price reductions as sellers try to sell those homes. I thought this chart was interesting, Josh, just because it shows home prices. Everybody wants to talk about, hey, the San Franciscos, these markets, the Austins, all of these markets, how they're down year over year. Well, we can take a look at this chart, right? It shows the top 30 largest metropolitan markets that Zillow tracks there. And, let's take San Francisco, for example. Yes, we're down 9.1% from the peak, which is essentially year over year, but still up 21% since March of 2020. And you can kind of go through this chart here. We're a little bit short on time, but you can see, Charlotte, 52%, the market went up. Miami, 53%. These are the markets, Tampa, 55%. These are the markets, in my opinion, when you see a slowdown, they probably see a bigger slowdown than other markets because they appreciated so much. So just pay attention to something to look at when you're looking at data and figuring out your next move. So Josh,
when I look at that chart, Jeb, the thing I want to point out is don't just look at the blue and the red. Look at how small the numbers are in the red, especially the year over year. So it's not to say that there's not any downtrend in some of those highly appreciated, more expensive markets. So it's generally the combination where you're seeing the ones that are having problems are highly appreciated and very expensive. But it sort of tells that story of this sideways trending market. Could be down a little bit month over month. It's up a little bit. We're sitting here saying at the time of year when there is generally less demand, less homes coming to market, inventory backs up, we would normally expect to see flat prices, possibly declining. But we're not seeing that in most areas. We're seeing these slight increases as there are very few homes for available buyers. So long way of saying, to me, this chart kind of supports that this sort of sideways drift that we're seeing and experiencing with clients in our market.
No, absolutely. So let's talk about residential construction, Josh. So what's happening with permits, starts, and completions? Is this going to be the answer that solves all of our problems?
It shows you that it's not going to be. They're not building enough homes. I believe the completions number for this year is projected to end up at about 1.4 million units. 1.5 is what's needed. They also say, and this number, again, lots of statistics that are accepted and been used for a long time. I wonder at where they come from, but the generally accepted number is that about 100,000 units are destroyed every year, become completely obsolete, demolished, torn down, burned down, whatever. So we're going to be about 100 to 200,000 short just for what we needed this year, much less the 3 to 5 million we were short over the last 15 years. So no, that is not going to build us out of that negative hole. And then the housing market index here, just again, more of that sideways drift in the middle. We went up from 55 to 56. It's up from low 40s earlier in the year, but 40 to 60, probably almost imperceptible to the market, to you going into a builder's office. Regionally, looks like the South and the Northeast are the strongest. West is a little bit better than the Midwest, but future sales expectations at 60, buyer traffic at 40. All of these things are in the 40 to 60 range, which just kind of tells you not bad, not good, just kind of moving sideways.
Yeah, and just to clarify, that's home builders is what you're looking at there. Basically, their confidence in what's happening. Percentage share of outstanding mortgages. So again, we talk about this all of the time. It's a really good chart to take a look at. 44% of people out there have a rate between 3 and 4%. What's crazy here though is 26% have a rate below 3%. So you've got 71% of the market with rates below 4%, guys. And that, again, is why you've got stability amongst housing prices in a world that is chaotic at the moment. And Josh, we'll take a minute here and just kind of talk about next week's episode on the educated home buyer. So today we recorded an episode asking, the questions: who are the sellers in this market with rates like we just saw in that example there, and inventory so low? Who's actually selling properties? And on top of that, where are the sellers going to come from? Where is the inventory going to come from in this type of environment? We actually break that down on next Tuesday's episode. So if you don't listen to the Educated Home Buyer podcast, that's different from this channel, by the way. It's another YouTube channel out there. It's also on Spotify, on Apple. Go listen to it. Getting a lot of feedback. A lot of these are coming from you guys. So go go subscribe. It helps us, it helps the YouTube algorithm, helps all of that. And for that, we are thankful for the support. So Josh, this is an interesting chart because it shows household debt as a percentage of GDP. We're at an all-time high, right?
No, absolutely not. You can see a deleveraging of U.S. households, and it happened pretty quickly from 2008 through 2012. How did that happen? Bankruptcies and foreclosures, mainly. I don't know that there was a whole lot of debt payoff. There was less debt accumulation. People were not taking on as much debt, but you can see here from 2012 through 2020, basically level, a little bump during the early stages of the pandemic, but still sitting here less than 70% of GDP. So if we look, Jeb, at the next chart, the reason why I want to show it, this is the same information, and this is how people can tell different stories with the same data. So the teal line there shows what the number is in actual dollars. So people will look at this and say, household debt is greater than it was in 2008. And you go, okay, that's true. But for us to exceed the level of 2008, we would have to be like $18 trillion of household debt. That measurement and putting into context as a percentage of GDP tells you the size of the total economy. A portion of that economy trickles down, goes to wages for debt service. So the US consumer has deleveraged a lot. So they have less debt. We just looked at that last chart showing what their mortgage rates are at. Jeb, throw it over to the next chart there. What is the majority of the debt? It's that blue at the bottom. It's mortgage debt. So not only do we have less debt, we have at record low interest rates. So in terms of debt service and what households are doing, they are sitting pretty, which rolls us over into that next chart, Jeb. Bankruptcies, foreclosures, and debt collection are at all-time lows. We're sitting here, and not only are they currently at all-time lows, they are unlikely to tick up the way they have in the past. We're sitting here, we debate here every week. Jeb and I debate every day when we see new data, but you see the headlines debating, oh, we're going to have a soft landing. Nope, a recession is still coming. Nope, soft landing. Nope, a recession is coming. Even if we get the recession, it's likely to be mild. Households are really well positioned. So anyone expecting this giant wave of foreclosures and bankruptcies and distressed sales, we don't have a recipe for it. If we look at that chart there, Jeb, on the bankruptcies and foreclosures, what it tells us, that's not to say, so in current times, 9% of households are in some form of debt collection. When things are bad in 2008, it's up around 14%. So it's only about 50% higher. Now, is that to say that no homeowner households, no high income households have poorly managed their finances and are likely to get into trouble? No, it will tick up. You don't sit here at all-time lows forever. But if we go from 9 to 11%, that's a 20% increase, but it doesn't lead to what we experienced in 2008. So people expecting that, hoping it, wanting it so that they can have a better entry point into the housing market. We talk about affordability being the headwind that makes it really unlikely that we're going to see rapid appreciation. This is the support, the life vest under the market that makes it very unlikely that we're going to have distress and forced sales.
No, good stuff. So that link is in the description now, so you can go check it out. You might have to refresh depending on when you jumped on there. If you're listening on the actual podcast, it will be there as well. So go take a look at it. There was a couple of charts we didn't go over in order to save time. Some of them are a little bit dense with regards to the information, and we want to answer as many questions as possible before Josh has to exit. But before we do that, I'd like to take a minute and ask a favor. If you find any value in these videos at all, in the lives, the time we spend here, do us a favor, hit the thumbs up. Helps the YouTube algorithm, helps push it out, helps us accomplish our goal. That's really why we are here, is to educate home buyers. That's why the podcast exists. It's why we are here giving our time. If you want to get in touch with Josh, it's really easy to do. There is a banner that is going to be scrolling here right now. If you go to that link on the bottom, it'll get you in touch with Josh. It'll get you in touch with me if you want to get in touch with me. And it'll get you in touch with a real estate agent and or mortgage professional anywhere in the country if you want to have that conversation. So thank you. All right, Josh, we are here now, and there's some good questions. This is one I want to touch on real quick because this is something that comes up all the time. You're going to be leaving, and I think it's a good one to address. But when will the spread between the 10-year yield and the mortgage rates go back to historical averages, or is 300 to 315 basis points the new norm?
Well, to put it in context, the worst we've seen is 3.1. That was a few weeks ago when rates spiked again. So what are we looking at? Why had the spreads been so low for so long? Went back literally back to the late 90s at that 1.7 to 2% range. Mm-hmm. We had slowly decreasing interest rates, and every time we hit a new low, the market concluded, this is as low as rates can go. So investors in mortgage-backed securities were not really worried about prepayment risk and the duration risk of getting loans refinanced in a short period of time. What we have right now, rates are really high. And even if they moderate, it's going to be a long time before investors get out of their mind that a 5%, a 5.5% mortgage is going to refinance soon because we'll have a market lower than that. It might happen, but we don't know that it will. But from an investor's perspective, you don't.
There's Josh freezing again.
That the money is going to go away, that it's going to get paid off, and you're not going to be able to get that return on the interest rate. You also have the volatility causes problems, and volatility basically meaning we don't know what's happening from week to week. Like we've had 3 whipsaws here where rates go up to 7, go back down to the low 6s, back up to 7, back down to the low 6s. So when we get to whatever the new normal is and the market concludes, hey, this is the new normal, I think it's reasonable to conclude it'll be higher than the 1.7 that we saw for the better part of 20 years. I don't think it's reasonable that that number is going to be 3 to 3.25, 2, 2.25, 2.5. You can sell me on any of those numbers. We're only going to find out through time, but I don't think 3% plus is the new normal.
Good stuff. Kim says, I get at least 10 alerts from Zillow a day. People are selling. Here's what's interesting, Kim, is that people are selling, but it's being met with buyer demand. Earlier you saw the chart here where I do inventory on Orange County. I do it on Huntington Beach. And typically I have these charts ready a couple of days in advance and we kind of add to the slide deck. But inventory I do on the day of. Sometimes I do it. I try to always update it right before the show to make sure the numbers are accurate every week and kind of along the same timeline so that, we actually have a trend there. Earlier today, I wasn't sure because I had some things going on if I would be able to update that inventory later in the afternoon. So I went ahead and put the numbers in about 11 o'clock this morning, came back and updated them this afternoon. Earlier in the day, Huntington Beach had, I think, 214 properties on the market. Were active listings. I went back and changed or updated the numbers. And as of the show, we're at 192. So we're talking about a difference of almost 20 properties in the time that I did that. Now, what happened? Some properties went into escrow. Some changed status for one reason or another. But that said, today in Huntington Beach, I think we had 7 or 8 new listings come to the market, but yet we're sitting at levels lower than we were last week. And that's because homes are being purchased. So yeah, you're probably getting alerts, but there are still people out there buying homes, believe it or not, even with higher rates. So just something to keep in mind. Just make sure you're not just seeing alerts, you're paying attention to what the total numbers are. And right now the numbers aren't really growing in any significant way. I think we went, 5,000 up week over week when last year we were up over 20,000 the same week. And that wasn't a big number either. So just context there.
Hey, Jeb, we have a really, really good question I want to get to before I leave. Paulina says, Logan Modeshami.
No, she said Logan Motosgano.
It auto-corrected on her. And Altos Research argue there's no mortgage lockdown. So what's the root cause of the lack of inventory? Is it because investors took advantage of the low interest rate the past 10 years? Logan, I love him. And 99% of what he says, I will take as gospel. He is insane. He looks back at 25 years of data and says, hey, every time rates went up, it has never led to a shortage of inventory. Well, we used an example on the podcast today. First American kind of threw the number out. In 2013, rates went from 3.5 to 4.5 and didn't cause any lack of sales. We still had a lot of sales volume. Well, first of all, affordability was still incredibly high. That's only a 25% increase in interest rates. We just had a 100% increase in like 7, 8, 9 months. The scale of that, there is nothing to compare it to in the past. Logan's going to die on that hill, and he is a very smart man, and I will agree with darn near everything he says. And I believe we've talked a little bit about what Altos is saying. Altos says, hey, buyers get used to the higher interest rates fairly quickly and adjust. And the volume of buyers has come back in the market after 2, 3, 4 weeks of higher interest rates. I have not seen them say anything about lock-in. I would love to see it. Paulina, shoot it over to us at info@theeducatedhomebuyer.com. If you have it, I would love to hear their take on it. I can't believe anyone seriously thinks that people are not locked in. Whenever we talk about this, we're going to have 5 comments pop up here before the end of the show. Absolutely, I'm not selling. Absolutely, I'm going to die owning this house. Absolutely, when I do buy another home, this is going to stay as a rental. So anyone that doesn't think it is an academic, someone that studies data for a living, not someone that actually talks to real people out in the real world.
No, I concur. Agree 100% with what you said there, Josh. I listen to Logan a couple times a week. I read what he has to write. I listen to and he states it every week. And his co-host, the actual host of the podcast, disagrees with Logan on it. And I agree with her on that take. But like you said, he's a smart man. He knows his data, but that's one thing where he's using historical references with regards to listing data coming up when rates change. And he doesn't have anything at the moment to look back on. But I think he will be surprised as if rates moderate some, and we'll see what happens. So anyway, all right. She did correct herself and actually spell his name correctly there. Let's see. Willing had a question here. It says, if a loan falls apart after an appraisal comes in, do you still charge the borrower? And basically they don't get a refund. So Josh, I'm assuming, charge borrowers up front, or the borrowers pay the appraisal typically up front before the appraisal is complete. Is that accurate?
Correct. If there were a situation where we failed, where we said, hey, you are pre-approved, this is a good deal, and it wasn't something unforeseen, something unknowable that popped up during the process, it's not our fault. But I will say there have been situations where we go in and mainly in a refinance market, we look at it and say, hey, it's 50-50 whether the value's there. And if the value doesn't hit this level, it doesn't make sense for you to do the loan. I'll split the risk with you. Appraisal $450, $550. I'll reimburse half of it if it doesn't come in. But unless we have made a mistake, the risk of that appraisal in a purchase transaction is definitely on the buyer. I mean, as soon as that appraisal comes in and a deal falls apart, certainly wasn't anything that we as a lender did. It's unfortunate, and we want to make that work out. And I've had situations like that, and I say, hey, listen, get out there, find another property. We'll eat the cost of the next appraisal for you, but not necessarily refunding the cost of it. And she actually, Willing has another question here that I really liked, Jeb, and I want your perspective on this. So she's asking me, do you consider yourself an employee of the Realtor? Are Realtors your boss, or is plan of attack based on sole borrower focus? So this is important. We actually had on the Vetted VA Live that I did last night, an agent went out of her way to point out that I am not your employee. It was a realtor. She says, as the buyer, the seller of the home, I'm not your employee. I'm your advisor. We're here to work together towards a goal. And that's really how I look at working with realtors. No, the realtor is not my boss. I am not the realtor's boss. We are two team members there trying to get you to the finish line successfully. We have to collaborate. We have to work together. We have to communicate, because neither of us can do our job the way we need to without that.
No, I mean, the simple answer is we're a team with a common goal, right? We're trying to help each other get to the finish line. Sometimes it takes some pushing and some prying on one other side in order to make that happen. Sometimes you as the realtor and or the mortgage professional have to do the entire job, because the person on the other side has absolutely no idea what they're doing. In which case, you guide people, you do the best you can. But ultimately, no one's working for anyone. We're all in it together, trying to accomplish the same task.
And every realtor can tell you a horror story of working with a completely incompetent lender, and every lender can tell you horror stories of working with completely incompetent realtors. Unfortunately, it happens on both sides of it way more often than it should.
Yep. And here we go, Anya. I'm not selling. 2.37%, 30-year fix. Guess what? That's the first one. What do you say? We need three more?
That's called lock in.
Exactly. All right. Josh, what happens the month after you pay off your mortgage loan? Are you done with the person or the company who bought your loan? And then do you pay the insurance company and Uncle Sam directly for the taxes? So there's no taxes on paying your home off, but you have property taxes, right? You don't pay those to Uncle Sam. You pay those to the county. But that's a good question. Do you still get an escrow statement? Is there still, I'm assuming there's an escrow account that's still out there, or not?
There is not. The servicer makes money off of a portion of your payment. So they're making those payments for you for servicing the loan. Once you pay the loan off, you will receive a reconveyance within 15 to 45 days that basically is recorded saying the deed or the mortgage that was recorded against your home that secured that debt has been satisfied. And they will also send you a notice and a reminder, hey, we're not paying your insurance anymore. We're not paying your taxes anymore. That is on you.
Well, that's good to know, because I've never paid off my mortgage, so I just assumed there was still an escrow account somewhere. But I even learn on the show.
We got two, Jeb. We're up to two.
We're up. Yep. Kel's got a 2.65 USDA. Not selling.
But we have people who are academics.
Third? Should I be putting mine in here too? Hey, I'm not selling either. But no, we'll just wait for, as they come in organically. Good stuff. Chris, a listener here, says, what's up? I'm closing in 2 weeks. And we had Dina, who is one of our regulars, congratulate Chris, and I will be the second. Say congratulations. That's awesome. Yeah, good stuff. Good stuff. Josh, what time do you need to leave? It's 5:24.
I got about 3 minutes. We got
3
Darren
minutes.
here.
This guy
2.625 30-year fixed. I'm not selling either. Wesley one ups that and says I'd rent my house at a loss before selling, honestly, and he's at 3%.
Well, there you go. Wow. All right. So Josh is leaving in a couple of minutes. Here's the deal, guys. There's not a lot of questions in there, and I'm not going to sit here and stare at you guys. I can't see you. I would stare at you if I could see you, but I'm not. I'm staring at the lens of a camera. So you guys got to get me some questions in here. Otherwise, I look like a monkey over here. We can
just keep posting. Alma's at 2.87, not selling. She'll turn it into a rental. Dina just closed at 6 1/8. So I would hope she's not selling. She just closed like 5 days ago. So we want her to stay in that.
Congratulations.
Home
I forgot about that.
Equity.
All right. All right, Josh, what do we got here? Is there anything that we can ask you before you leave that will help us that I don't know the answer to? A lot, quite frankly, but we'll go with this one. When talking about stats and HELOCs, does that include second mortgage, 20-year fixed, which is not a HELOC? So when you're talking about mortgage debt, Josh, are they wrapping, the way I'm reading this, are they wrapping the equity lines into that mortgage debt?
I believe it's all subordinate financing, home equity lines of credit, home equity loans, anything that's not a first position mortgage. Don't quote me on it. I wouldn't bet my life, but I would wager a decent amount.
All right. But Josh isn't a betting man, so his decent amount's minuscule at best. All right. Josh. Paulina is asking the question, is there any statistics that show how many houses are owned by investors? I'm sure there are some stats out there somewhere. I haven't come across a percentage. We typically get updates monthly from existing home sales, just showing what percentage of purchases were investor, what percentage were cash. And it's on average 15, 17% or so are investor purchases. Maybe it's 25. Am I getting confused with the cash? I can't remember. Either way. So I would guess, Josh, I'm really guessing that probably 20% of the market's probably investor owned. It could be higher than that. Any thoughts?
No. And I bet you it's less than that, but I could be wrong.
All right.
Here. Well, I was going to say I almost had some Google data, but this is just into 2022. Last year, 22% of homes were bought by investors. So we know that number. That market has been 20 to 30% over the last few years, and that's higher than normal. So that's a good one. Well, we should track that down.
We'll see if we can find some actual data on that. But in today's episode, when we're talking about inventory, one of the things that I mentioned is that everybody thought that investors were going to be the ones to sell property because of all the moratoriums and all of those things. But what happened was investors were able to refinance property, take their rate down. Many of them are owned free and clear, but they were able to refinance, take that rate lower at a time when rents are going up. So rents went up. Mortgage payment went down. So their spread, their cash flow increased in many cases significantly, and rents are continuing to increase. Yeah, they've decelerated. They're not going up at the same rate, but they're also not going negative in most markets either, which is why you're not going to see investors come to the market. And these big funds that have lots of properties, we talk about it all the time. They have a fixed asset, fixed return that they're able to predict with really good accuracy as to how much money they're going to be bringing in for investors, for their funds. And that's a lot of money to try to put somewhere else into another asset that produces that type of return, which is, there's no reason for these investors to sell these properties unless they're incentivized some way by the government with tax, benefits and that sort of thing, which we're not seeing at the time. Josh, it's 5:30.
I know. I feel bad because they just fired off with a bunch of really good questions. So if we don't get to them, maybe we'll lead off next week. StreamYard now allows you to export all the comments.
You can go into StreamYard on your phone. Come in mobile, Josh. I'll send you the link if you want to be mobile.
while I'm in traffic on the way to the airport.
There
All
you
right.
go.
I think you're going to be just fine without me. So you guys, thanks for showing up. If you have any questions, you've got the scroll down there. And more importantly, Jeb, what I wanted to say when you were talking about the podcast, the best ideas come from you guys. Go back through. Don't ask if you haven't looked at the episodes we recorded. There's about 80 episodes out there now, but go through, see what's there, see what's not there, see what holes we have in the information that we've shared that we could record episodes for you guys.
There you go. We got another 2.52. Not going anywhere, Josh. Anyway, all right, bud. See you next.
Adios.
Adios. All right. See ya. Amigo. All right, guys. So now you just got me, unfortunately. Wow, it's been a while since you just had solo Jeb. So let's talk. I got to go back through the questions now and add some here. But you have questions, continue to push them in, put them in, and I'll do my best to get through them. We'll go with one here from GMC Edwin. GMC Edwin. Edwin owns a GMC. So Edwin asks the question is there any alternative out there other than using a bank? There are, private money lenders that will finance outside of a bank, but typically you're looking at, 30% plus down on something like that and a much higher interest rate. Banks are typically going to be able to give you the best rate, the best terms out there in the market. And when I say banks, I'm also talking about brokers, anybody that's out there actually doing loans. Hard money isn't really the way you want to go. If you have property, there's ways to leverage it and do bridge loans and that sort of thing that allows you to avoid the bank. But at the end of the day, the bank is going to have the best financing, overall. So hopefully that is helpful for you. Kim asked, what is the next podcast about? So I mentioned it earlier. The next podcast comes out on Tuesday, is talking about inventory. It's talking about selling, it's talking about the changes in what's going to happen there, what we see, we don't see, and the direction that's going to push things for the foreseeable future. So if you haven't done so, this last week we talked about gifts. We realized that we'd actually talked about gifts a couple of weeks ago, or a couple months ago at this point. It just, when you have 70 plus episodes out there, you forget of some of the things you talked about. So we actually re-recorded an episode that we had previously talked about, but it had some different things in it. So hopefully you guys still find value in it, but you can help us by telling us what you want us to talk about. If we don't have it done, that really is what drives, the show and helps us stay relevant to what you guys are actually looking for. Ile says, have you had any clients buy down their rate? If so, how much is 1 point getting these days? Still a quarter percent, or can it vary? So, I am usually not aware of my clients in what they do on the interest rate front, as far as buying down rates and that sort of thing, because they get pre-approved, because it's two separate businesses, and the mortgage professional and myself. Unless somebody tells me what they've done, I'm not able to get that information. Lately, I don't know if I've had down or not. I know I did towards the latter part of last year when rates went higher. I assume there are definitely people still out there doing it. You're probably going to see more sellers willing to contribute to that cost just because of where rates are. But as far as 1 point getting a quarter percent, that's pretty much how it's been, historically. So I would say that's probably pretty accurate. That if I were a betting man, which I am, I would say that that's probably what I would go with. Right. What do we got here? Fred asked, what types of loans are you guys seeing get used more these days? So, I would say traditionally speaking, the bulk of my business are conventional loans, putting at least 5% down. That is the primary bulk of my business. Occasionally I'll have an FHA loan here and there. Occasionally I have a VA loan here and there. But, I obviously have the benefit of talking to Josh about the types of loans he does. And so he does VA, he does FHA, and I know he has a couple of both of those at the moment, along with conventional loans. So I would still say that probably the bulk is conventional and maybe 10% VA, percent FHA. Those numbers might even be a little bit less with the bulk being conventional, but because of some of the guideline changes with LLPAs and high rates, more people be using FHA financing because if you have an interest rate of 680, it almost you know makes it 100% of the time to do the FHA loan just because it being a better scenario all the way around. Unless you're putting significantly more money down. If you're putting more than 10% down, then it probably still makes sense in some cases to use conventional. But if you're going through that process, have a lender run both, right? Have them run conventional, have them run FHA side by side. Most of these guys are using a program called Mortgage Coach where you can put in the numbers and really see, hey, all of the cost, what it looks like. And from there, you make a decision. But something I talked about in a video earlier, because there's a lot of people at the moment that have FHA loans that are reaching out and they comment on my videos. You can go see them and they say, Jeb, I have a 3.25% FHA loan. Should I refinance? I'm like, absolutely no world in which you should consider refinancing. And the easy way to figure that out is, today's rates are 6.5, 6.75%, somewhere in that ballpark. Well, if you got a 3.25 FHA rate, yes, it has mortgage insurance on it. But the easy way to figure out your effective rate is take whatever that mortgage insurance is, add it to your rate. Well, mortgage insurance today for people putting 3.5% down is 0.55%. Well, that's gone down during the pandemic. And when a lot of these FHA loans were done at lower rates, it was 0.85%. So if you got a 3.25% rate and you got 0.85 on your MI, then you basically got a 4 1/8 interest rate. That's significantly better, over 2% better than today's rate. You should not consider refinancing. No world. I mean, you would need rates to get back down, below 4% to even make it make sense, because it's got to make sense to FHA in order to even do that refinance. So something to keep in mind there. Think about the effective rate that you have. Yeah, it sucks to pay mortgage insurance, but it sucks even more to go to a higher rate and pay costs to do it. So just something to keep in mind when you're out there looking. Um, what are we looking here? Paulina, another good question asking about inventory, just saying, I'm wondering if investors acquire high amounts of property to rent out and it's contributing to lack of inventory. Yeah, it is in some markets, absolutely. But it's not the sole reason. It can be, a year or so ago, there were builders out building entire communities, selling them to investors. That's a problem, right? Because you're taking inventory that could be sold to the general public, if you will, that is now being turned over to rentals. That creates, puts more distress, if you will, in supply, which creates, you know, longer lasting issues. And sometimes it's the investors on the other side of that. Overall, investors buying property, small percentage of the overall inventory issue, but they definitely add to it. Mukisa says, how do I find assumable loans if a seller has a pretty low rate? It's not something that you can find easily. At least, here in the state of California, it's not. Some of this data is public. Um, there the only loan that's really assumable out there is an FHA loan and VA loans, right? So those type of loans are assumable. Most conventional loans are not assumable. So with that said, you've got to find, somebody that has an FHA or VA loan at a super low rate. How can you do that? You can have a real estate agent, like here in the state of California, data is public record. So you can have a title company run, hey, in this area that has an FHA loan with a rate below X. They can pull that information. But once you have it, what are you going to do with it? You can send a mailer out to them. You can go door knock them. I mean, there's a lot of things, but chances are it's a lot of data to weed through to really get down to finding somebody that would be interested in selling. Is it possible? Absolutely. But understand, it's an assumable loan, but the lender still has to allow it. The lender has to allow it. You still have to be approved and meet the guidelines in order to do it. If there's equity in the property, which most properties have, here's the caveat: equity. You've got to be able to give that equity. You got to be able to transfer that equity to that potential buyer, for them to transfer the loan, right? So if somebody say a home's worth 500,000 and then all they owe is say 300,000, they have a super low rate of 3%. You want to sell a home where you're like, hey, they got an FHA loan. It's suitable. I'd love to have that loan. Well, guess what? They have $200,000 in equity in that property. Chances are they're not just going to give that up and leave it. So you've got to be able to pick up that difference in order to be able to assume that loan and finance it. So that's where most people get it wrong. They just say, you know, it's assumable. I could just take it over. Well, yeah, but there are other things in there that you got to keep in mind. So hopefully that was helpful in answering your question. Man, talking by yourself here, it's get your throat. Um, let's see, what do we got? All right. Well, we're still moving along here. Ile says if seller and buyer are 5 to 7% apart on price, but seller won't move and home hasn't sold for 2 months, what can the buyer do? Assume buyer is at qualification limit in Orange County average prices. Nothing. I mean, really, I've got one of those at the moment. Seller won't move. I had multiple offers. One that where we were getting close. I mean, we were really close, and seller is not budging on price. One of the buyers won't come up. We've been on the market over 3 months. Nothing you can do. Right? We can adjust our price. We still have room to adjust our price. In fact, we adjusted it yesterday. We're getting activity on the property, but there's not really a lot that can be done there when you're that big of a disparity in price. Somebody's got to give in order to make a change. So that's the simple answer. Paulina, again, it seems to be the Paulina show tonight, says, when interest rates come down, can I refinance my conventional loan to an FHA? Sure, if you're eligible for VA. Did I say FHA? I meant VA. Can you refinance it to a VA? You could also refinance it to an FHA. VA requires that you're eligible for VA financing. Yes, you can refinance into a VA loan if you're eligible to do that. So yeah, that is an option. All right, guys, no questions here. 42 minutes. So I'm going to take this time to ask a favor. If you find any value at all in my channel, in the videos that I do, hit the thumbs up. Helps the YouTube algorithm, helps me accomplish my goal. So I'm trying to hit 100,000 subs. I'm 13,000, 14,000 away. It's a goal that I would love to accomplish this year. I can do it by you guys helping me, and I would be grateful for that. Also, if you haven't listened to the Educated Home Buyer podcast, separate channel entirely here on YouTube. Actually, there's a link in the description of the video, but it's also on Spotify. It's also on Apple. In fact, this episode is taken every single week and put on the Educated Home Buyer along with the normal episode that we film. So every Tuesday, there is a deep dive into a topic, mortgage and or real estate related, kind of a 30 to 40 minute dive into something specific versus bouncing all over the place. And then you have this posted every Friday. So if you like this type of content, don't like to look at my face, just want to hear the audio, you can go to the podcast and watch it. Now, it doesn't go on the YouTube page most of the time, but we are streaming there this evening just to see what it looks like as far as analytics go. So that said, Cyrus has a question. Jeb, I know you're bullish on the market, but when do you think rates will begin going down? How many years will it take before the Fed pivots? I think the Fed pivots. Pivot. What is pivot? Pivot, is pivot a pause, or pivot actually like they reverse course and move rates down? If it's the latter part of that, I think it's probably early next year, unless you see a big jump in employment this year, which it doesn't look like it's going to happen. It looks like employment is strong. All the data out there still shows somewhat of a resilient economy, although a lot of the indicators that have pointed to a recession 100% of the time are flashing recession, later this year, early next year, it still looks like a soft landing. And if that's the case, I would be really surprised. But that said, I think a pause def, definitely happens. You know, could it happen before next Wednesday? I don't think so. I think the data out there still shows that, you know, that inflation is quote unquote not coming down to their 2% target. Although we know some of the data is lagging and is not going to report, quite accurately yet that the Fed is probably going to do a 0.25% raise again, but it's already built into the market. So that shouldn't really have any effects. But what could have an effect is their verbiage, right? When they, in their press conference, did they change anything? What did they change? What does the dots look like as far as, indicators of where, rates will be in 6 months or 9 months or whatever, right? So that's the key. But to answer the question, I think they probably pivot first part of next year with some sort of pullback in the Fed funds rate. Now, is it going to be something significant? 50 basis points? Probably not. They're going to probably start and kind of see what happens. But I think you'll see rates go lower before that. I think there's a good chance by the end of the year you see rates in the low sixes. You know, there are people out there that, are way smarter than I am that do this for a living that think you'll see rates in the fives. There's some that are super aggressive and think you could see them in the mid fives. I think at this point, there's no, I don't think the spread's going to change in the 10-year and the 30-year fixed enough to allow rates to compress that much. Huh, we will see. But yes, I am bullish on housing, not because I'm a perma bull. There are times when I think it's better to buy a house than other times, but I do know, that lack of supply and demand continue to drive markets, and I know what home ownership does long term, and that's why I think it's super important to own real estate. Let's see. Kim says, Jeb, what are some YouTubers we shouldn't take advice from when taking the road to buying a home? So I'm not going to go out there and put anybody on blast. If I'm being completely transparent, I don't follow any other YouTubers that talk about real estate on any significant basis, right? I mean, any consistent basis. People send me videos all the time, ask me questions, clearly have conversations offline. There are people that have been wrong for the better part of 3 years and continue to push the same narrative. And it becomes, something new every time the last theory didn't work out. Those are the people you shouldn't pay attention to. Go look at a track record, right? Go watch videos from 2020. Who was That's honest to God. That is really what you do. Go look at old videos. If there's none there, chances are they deleted them, especially when they have a lot of subs. But go look at my videos, right? I'm no expert on economist, but it was really easy to look at what was happening on. But yet at the same time, there are people saying this is going to crash the market and so on and so forth. So really, that's it. Go look at them. I wish there was an easy way to find things that I said and pull up information because I would make videos about it, but it just takes so much time to go back and do it. Um, but there's some good stuff back there from a couple years ago. All right, here we go. If I want to refinance, am I tied to refinance with my current lender or can I refinance with any lenders out there? You can refinance with anyone. You don't need to go back to your current lender. Sometimes your current lender will offer you better terms because they already have the loan. They want to keep it on their books. Other times, they're not the most aggressive. So even if you're getting a quote from your current lender, get a quote from somebody else, especially if you're dealing with big box lenders out there. Go to somebody like a broker using that referral link below and have a conversation and just compare. It doesn't cost you any money. This is what I'm getting offered. This is what I'm getting offered over here. Look at the loan estimates. Look at box A on the loan estimate. Box A. It's all you need to pay attention to. What is it costing you? Obviously, pay attention to the rate, but what is it going to cost you to get that rate? Compare the two and make a decision. Okay. I think I knew says how much equity do you need to refinance? That's a good question. I don't know in this current environment how much you need to refinance. I think you could probably, if you're just doing a rate and term refinance, not pulling any cash out, you could probably go up to 95%. The VA probably go up to 100%. I mean, those were the guidelines back in the day. I'm assuming that hasn't changed. If you're pulling cash out, then obviously you had to have a lower loan to value, but you don't have to, you just got to have enough equity to be able to to pay off the current balance and not be over in most cases in order to go through. All right, guys, it's 5:50. My voice is going out. Let's see. You guys aren't asking any questions. That must mean you're bored. Are you bored? Are you guys bored? I'm going to ask you a question. What channels do you follow other than my channel? That's what I'm curious about. Real estate or not? I want to know who you follow. Who do you like? Who do you like out there in the space? On top of that, I'm going to ask another question. So let's get some answers on that because I want to hear who you guys are following and who you find value in. One rental at a time, our Rod says. Good information there. Um, Zuber's a smart dude. Paulina says Housing Wire. Housing Wire is great. Um, Another for one rental at a time. That's good. Meet Kevin is one. Does Meet Kevin even talk about the housing market anymore, or is he just? I mean, I guess I ask for everything, but um, all right. Oh, yeah. Javier in Arizona, Bigger Pockets podcast, also another good one. Loan Officer podcast. The Loan Officer podcast. I don't know of that one. Michael Bordinaro. He's kind of on that crash train, guys. Dina, kind of on the crash train, or was for a period of time, at least when we did a little collab back in the day. He was really pushing the idea that things were going to change. Guess what? Todd Sachs, another good one. Christina Shahida rather Hill. So all these people I've heard of. So I'm not really getting any that I haven't heard of, which is interesting. You would think there would be more people out there doing, educating, that sort of thing, but there's really not a lot. I just came back from a conference out there and in Vegas, rather, kind of marketing, kind of quasi social media, that sort of thing. So it was good. Hi, the real estate guy. I've seen his channel. Don't follow it. Um, are you boosted up? Well, if you are unsubscribed, what does boosted up mean? Jason Walters, Clear Value Tax Guy, also another good one. Yeah, so a lot of these guys I've heard of. But yeah, so what are people talking about on these channels that we haven't addressed or I haven't addressed that you want to know more about? If you take the time, let me know. In the meantime, I'll try to answer the questions here. Sir Ashley. So had Sir Ashley on for a bit and then he disappeared. He had some connection issues, internet, and then never heard back from him. So I guess he was maybe not a fan of the show. I'm not sure. Dan Frio. So yeah, so good stuff. Willing, vaccinated. Oh boy. All right, here we go. I'm not going to get into that because it's a political thing. So call me off air. We can talk. I'd love to get a recommendation on someone who's as honest as Jebba, based out of Florida. If you guys have recommendations, so depends on where you are in Florida and what you're looking for in the. I know a lot of people in Florida that do real estate content. I just know some really good people in Florida that don't do real estate content too. So if you want an agent that to talk to you in your market that's like reputable and knows what they're doing, reach out to me. I'm happy to refer you to somebody. And I know personally you can have a conversation with, off or maybe on, but they're not YouTubers in some cases. So anyway, that's where we're at, guys. We're at 5:54. And then we got dummies that come in and say housing cheerleaders. Yeah, that's a dummy. Dummy. All right. All right. Here we are. Where are we? Christina is obviously another good channel. Let's see. So all of those are good stuff. So not really a lot of questions at this point. I think I've addressed everything. Is there any final questions, guys, before we go off? What is your final question tonight? Nothing? Elay, another one. It's kind of been the Elay and what was our other girl's name? Felina's show. What kind of incentives, if any, have you seen sellers offering on resale homes to push a sell over the line? I've seen credits, you know, I've seen everything in my career, but recently not a lot. Just because the homes that are priced correctly are selling. But I did have a condo here recently that was had an issue with the homeowners association. It was not Fannie Mae approved, so it was an unwarrantable condo. And this is something we're going to talk about in another video because it seemed to be a surprise for agents and borrowers when hearing the term unwarranted. Nobody knew what the hell it was. But that said, it was unwarrantable. So financing became an issue with this. My client was really looking to sell the property. So he was starting with the idea, hey, listen, I'll give a credit. I'm willing to do repairs. I'm willing to buy down rate. Willing to give closing costs in order to get a transaction closed. So really depends on how desperate somebody is, what they're trying to accomplish on the other side and what they're willing to offer. Some people are willing to do it sooner than others. Some people aren't willing to budge at all. I have a neighbor, for example, that's been trying to get X price for his house for the better part of 4 months now, 3 4 months. Said he wasn't budging. I'm not budging on my price. This is my price. This is my price. Well, he went into escrow at that price on a contingent offer of another seller who needed to get X price for their house. Well, guess what? Both of them were overpriced. The one that was buying his house and his house. Well, now we are today. We get an update. Price has been reduced. So guess what? Finally started to cave. And the best part is now it's only $100,000 overpriced versus 150. So as it starts to go down to where it should, assuming he truly wants to sell, then you'll start to see the market move. But that was just me kind of getting that out of my chest. All right, guys. Let's see. Is this still live? Yes, Super Triz. This is still live. All right, guys. I'm gonna see here if Super Triz has a question. Chandler asking, how long do you think new construction incentives from builders will continue? Uh, Probably not very long, just because a lot of new construction in a lot of markets is the majority of inventory out there. So buyers want to buy something, and then they're having to consider new construction. So the new construction crash, if you will, has been more of a bust at the moment. Now there will be more coming to the market if you're in a market that has a lot of new construction and there's very little demand, then you probably are going to see more incentives. If you're in a market that has very little inventory and new construction is a small portion of it, and people are still buying it, the communities aren't just sitting there with no one in them, then there's no reason for them to really do incentives. But in some cases, they're still going to do some small things for rates and that sort of thing to make housing, to make it less shocking when buying some of these properties. But I would imagine, the incentives kind of are what they are for the time being, unless you see a big change in the market. All right, guys, it's 5:58. So I'm going to ask one last time. Hit the thumbs up if you found any value. Subscribe to the channel if you haven't done so already. Let me know. Email. Reach out to me if something you want us to cover that we haven't done so already. If you want to get in touch with me, that link scroll in the bottom will get you there. If you want to get in touch with Josh and or a mortgage professional or real estate agent anywhere in the country, that link will also work for that. No cost involved. And lastly, well, that's really it. So I appreciate you. I appreciate the support. I appreciate you guys showing up every single week. Next week is the Fed, right? So we're going to know what the Fed's doing. We're going to know what they said. Next week should be a good show because we'll have a lot to unpack. But until then, guys,